26 years of CNBC-TV18.
Kospi, the South Korean index, the outperformer of the year, down around 0.5%.
They have to pay tariffs. Do they have an exemption on rice?
No, sir. We're still working on their trade deals.
The Nifty, of course, ended below the 20-day moving average, which is 26,020.
At least on the Nifty, there's a good chance that we bounce from the lows of the days.
Board's silence in what can actually be construed as almost like a sort of mini disaster is an element of concern.
It's about 90 points lower, 25,875.
There were lots of excesses which were built in many sectors and subsegments, and in the last 6 to 8 months we have seen them clearing out.
Q3 has begun pretty well. We had a very good festive season.
Another day of fall that we're seeing in the markets, though in last couple of minutes we're seeing some recovery that has come by as well.
A revised schedule, winter schedule by 5 p.m. tomorrow.
Passengers' convenience and dignity are being protected.
Advance decline ratio has turned into the favor of advances.
Okay, this is closing bell. There was a day so far, and a much better session as compared to yesterday's trading day. 200-point recovery on the Nifty from the day's low. 100 of those 200 points have been given back, and we are down about 130 points. This is closing bell, and we are coming to you from the CNBC-TV18 Moti Rosewal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, afternoon.
Hi, it's just in the last 10 minutes, again, there has been a bout of selling pressure. So the Nifty had pretty much made its way towards 25,900, I think about 25,890. So from that level, just pull up the intraday chart. There you have it. 5 minutes and the markets have sort of nosedived. But the good part is the advance decline ratio has flipped.
Yeah.
At 10 o'clock, which was the session low, I remember it was 1:7, one stock advancing for 7 declining stocks. And now those lines have crisscrossed, and firmly now. We've got more gainers, we can say, than losers today.
Well, that's right, Rima. That's the most heartening aspect, right, about today's trading session, that we have the number of stocks advancing or more than the number of stocks declining. And if I got that correct, this is the first time in December. Yes, this is the first time in December that the number of stocks advancing are more than the number of stocks declining, because I pulled out the data yesterday for all the previous trading sessions. So hopefully it stays this way and doesn't do another crisscross. But at least a little bit more encouraging looking screen because of the breadth of the market.
Even rupee is a lot more benign.
Yeah.
The level on the currency, I think it's about 89.92 versus yesterday's closing level of 90.07. So 89.94. It's a little more constructive on the currency. That helps.
Rupee ka to ho gaya, is saal ka.
Ho gaya?
I think market also hopefully ho gaya.
The worst is behind us.
Well, never say never, but rupee more like it, because I think stocks. Rupees. It's more. There's a fair bit of foreign. Of course, for the stock market as well, foreign influence is large. But for the stock market, there's domestic support. For the currency, there was a fair bit of selling from overseas players, exporters, etc. And as that activity starts to wind down, maybe that 90.42, which was the low, perhaps we won't see it for the rest of the year. 16 days to go, 16 trading sessions to go. Let me just quickly run you through what's lined up here. So a bit of caution across indices. There are big bounces as well, and we'll discuss whether, the 10%, actually not 10, but 13% bounce on names like Keynes is like a dead cat bounce, or is it turn now? The decision from the US Federal Reserve, and we'll get you expectations on it, decision, of course, tomorrow. We've got lots of other stuff. Keynes, of course, is something we'll talk about on the back of that Macquarie note, which I think is also sounding a little bit more positive. Indigo is trading in a 300 rupee range. It's down sharply now. It was above the 49.50 level, but it's completely given up gains there. So at 49.50, it was flat, unchanged from yesterday, but a fresh wave of selling coming through. So actually, the big stories are unchanged in terms of individual single stocks. It's Keynes and the EMS, and of course, the other one is Indigo with what has happened. Both seeing a fair bit of damage recently. What are trades? How should you position yourself? That's the question. Mitesh is with us with exactly that. Mitesh, take it away. What would you do? And I think the Nifty Bank also, tested the 20-day and has bounced from there today. So what's the trade, if any, on the indices and then stocks?
Prashant, we're still looking at 25,800. I think that's for me a very important level, but we haven't got, a reversal sign, though there was some bounce on an intraday basis. So the idea is that you reduce your short exposure, see if this 25,800 can still give you a bounce as we approach the last 45, 30 minutes, because then we'll have an expiry as well. And, only if it closes below this 25,780 zone, then I think I'll look at going short again. But for the time being, I think, exiting, taking some profits on the short side and exploring some long positions. I have, in fact, two buy calls right now on the stock side. One is Policy Bazaar, which has held on very well in this correction. So buy here with the stop at 1914 for targets of 1995. And CG Power appears to be rebounding from oversold levels. So buy around 660 with a stop at 647 for targets of 685.
Okay, all right. Thanks a lot, Mitesh, for giving us those calls. Well, Keynes Technology, that's the one that's bursting away post the sharp correction. We have a couple of brokerage notes that came in as well. And in addition to that, the stock is possibly bracing to come out of the F&O ban, as per what my screen indicates. The open interest as a percentage of MWPL, market-wide position limit, has come down to 79%, which is good enough for it to come out of the F&O ban. That's the technical aspect. Upasana joins us to tell us what's going on fundamentally with the company. Upasana?
Well, the stock continues to remain in focus even in today's trading session after the brokerages turned positive, after the company clarified certain things in its investor call. Now, if you look at the stock move, it's down about 22% in a month, down 42% in 1 year, and it snaps its 3-day continuous losing streak after the brokerages turned positive. Now, if we look at the consensus rating, buy 54%, hold rating is 31%, and sell 15%. Amongst all the brokerages, the highest target price is given by Macquarie. It has given an outperform rating with a target price of 7,700, followed by PL Capital that with a buy rating, target price 5,624, and the lowest is given by Investec with a sell rating and a target price of 3,750. Now, if you look at the Macquarie, it says that no irregularities have been observed, but management will need to take effort to regain the confidence of the investors. Company has defended itself against the reports of accounting irregularities by accepting disclosure shortfalls, but it feels that the management's clarification sounded quite reasonable. It sees a strong cash flow generation and organic growth for the company, and it believes that a change of auditor is needed to restore the confidence. But today only, the company has clarified on the back of the Money Control's report on the change in company's auditor, it has clarified that no such decision to change the statutory auditor is under consideration. So all in all, this is what the reason the case is buzzing into today.
Thank you for recapping all the events surrounding Keynes Technology. A solid rebound, 13% up on that. And now the stock trades at about 40 times forward multiple. A month back, it was close to 70 times. And the stock is corrected close to about 50% from its all-time high levels. Dharmesh Kant is now joining in from Chola Securities. Dharmesh, after a fall from highs of more than 7,500, do you think all the froth is out? Or is the news still concerning? I mean, how would you approach Keynes Tech?
Yeah, Dr. Rima. See, our call was very clear right from the beginning on the EMS space, and that call was that growth rate is going to decelerate going forward. So this, look at Keynes in 23, they delivered 100% profit growth, 24, it was again 100%, and then it came down to 60%. And now they are targeting around 45 to 50%. Going forward, in light of the competition and everything coming in, we believe this growth rate will further come down to 25 to 30% in next 2 to 3 years time frame. So with respect to that, I think 40 times 1 year forward P multiple is still expensive, though because of so much happening in the company and so much, price destruction has happened, some opportunistic trades will play out. And because of that, we are seeing a bounce back. Some short covering rate technical trades are also playing out. But the advice is to stay away, wait for some more time correction to happen and see, H2 of Keynes, particularly because H1 was not that great. So whether they are able to deliver this 45-50% kind of a profit for entire FY26 would be critical in determining the future course. So to our mind, it's at best neutral to negative kind of a stance on the valuation front.
Okay. All right. Got that, Dharmesh. Well, Coforge, they've laid out the ambitious growth plans at its investor meet. The stock, though, is trading a little under pressure. Rima, you want to tell us more?
Well, the guidance at the investor meet yesterday was very positive. Maybe what the street is disappointed is that last investor meet, they laid out their target of saying that we will achieve $2 billion in terms of revenues. This time, they're not quantifying the future guidance. So they've said for FY27, we're not going to give you a guidance, at least as of now. On margins also, they will hit their goal of 14% towards the, by the end of this year. But thereafter, the company said we will not be giving a guidance, but we will use 14% as the base. Right? It should perhaps be more than that. But maybe the fact that the management is not quantifying the future guidance could have disappointed some on the street. That said, the commentary was upbeat. They said that, $2 billion was the revenue run rate target. In one answer, they said maybe by the year end. In one answer in the Q&A, they said, in the next couple of quarters. But it basically means it's imminent. The company should see a revenue growth of about 3-4% CAGR. They reiterated their endeavor to maintain industry-leading growth. Again, reiterated that 14% margins will be hit by the end of this year, but thereafter they will not give a guidance, but 14% will be the floor. Tech budgets are not out for next calendar year, but according to them, it should be low. But, for companies like Coforge, which are being very proactive, they go out to the clients and say, this is the problem we will solve for you. They're not waiting for requests for proposals. And they're saying for people like us, the tech budgets are actually growing quite well. They also expect, there's a lot of conversation on AI. They're building the capabilities to the Quasar platform, and they do believe AI will be net positive. No plans to invest further in the data center business. On free cash flow to PAT, they will maintain it at 70%. Nomura says it's the top pick in the mid-cap IT space. Their target price is at 2,000. But as I said, commentary is bullish, but there was no incremental quantitative guidance shared by the management in this investor call. Maybe that's why the stock is corrected, or it's just profit booking. But now, year to date, it's turned negative. YTD stock is down close to about 3%. Ramesh, you want to quickly comment on Chola you want to comment on Coforge? And did your analysts attend the Coforge meet? What was their key takeaway?
I mean, the very fact that the quantification of the guidance was missing does create some nervousness. And normally, Coforge is as you mentioned, it's already a proactive company. And the numbers were excellent for last 2-3 quarters. Both Coforge and Persistent were consistently delivering a very good set of numbers. And the last con call was pretty exciting. I mean, there was a confidence level was pretty high. But abstaining from, quantifying the future growth trajectory does create some sense of, nervousness. But I do think because as they are closing in on the year, but they would like to, commit as of now. So our sense is in case of a correction happening into the stock, some bigger correction, not this much which we are expecting. If it is down 4-5% more from the current levels, then we are looking at buying this opportunity. We are taking it overall holistically on a positive thing, and we think that the consistency of past growth of around 25-30% is likely doable, and 14% margin going forward should be sustainable.
Dharmesh, afternoon. That's flash at the bottom of the screen, right? Swiggy not to raise that money. The shareholders have okayed. You think as we enter 2026, Swiggy has clearly lost market share. And now they've done this second round of fundraise in short order. Zomato is already sitting on cash. Everybody's sitting on, between 10-15,000 crores in cash now. Swiggy as well will after this fundraise. And most likely, I'm assuming going by what has happened before, Swiggy will try and outspend to regain some of the market share. So, I mean, not a great scenario, right? For anyone for that matter, for Eternal, which is the leader as well, at least for a while. I mean, then of course, some of the underlying fundamentals, dynamics, etc., will be the driver. But for now, at least in the next 3-6 months, what's your sense?
Yeah, Prashant, good afternoon. I mean, definitely, this is the scenario which we have been building in for last 1 year. And the sense was very clear. I mean, I remember 5-6 months back when Eternal hit first time 300 stock price. That day I was on your channel, and clearly I voiced out that there may be 15-20% kind of an upside based on the momentum, where valuations are very hard to justify, and the competition is hitting up. So this cash one will come into play, no doubts about that. And the margin of even 1.5% on the operating front would be difficult to sustain on a long-term basis. So, I mean, valuations has already been discounted. We may trade here 15-20% up and down for the next 2-3 years. But beyond that, at this juncture, I mean, Swiggy or Turner being a wealth creator, I seriously doubt, but that's not to be a scenario. It can at best be a trading place based on news flow. And Amazon has still not entered the market the way the expectation was initially when they tried doing their pilot projects in Bangalore and all. So once they also enter the food delivery business and other areas of the business where these two are active on the platform business, then it will be further competition, coming to play. So it's a wide open, but technology is not a barrier here. So such kind of a place has to be taken with a pinch of salt, and a very cautious approach has to be adopted.
Yeah, got that. Next question to you, Dharmesh, is Indigo. But let's just set this up, set the question up with the latest with Shivani, who's joining us from Delhi. Now, the DGCA has curtailed Indigo's winter schedule amidst widespread flight cancellations. Shivani, tell us more. I mean, what the understanding is, they had approvals for all these flights, but they were not going to fly anyway. So, I mean, is this basically cut back in that sense? The bigger question, Shivani, is we heard the aviation minister, and maybe we can just play out the soundbite a little later. How is this going to go from here? What's the government's thinking in terms of what is going to happen from here? Stock's been selling off. Go on.
Well, Prashant, that is absolutely right. The DGCA has said 5% curtailment on all Indigo flights. This is on the basis of the winter schedule that they submitted in November. So let me just give you a background of why this has come to, this point. It's not just on the basis of the 1st to 7th in the last 1 week that we saw the disruptions. The DGCA has put out numbers which are very stark. According to the DGCA numbers, Indigo had taken permission for around 64,000 flights in the month of November, and out of that, close to 1,951 flights were cancelled already. And then we saw what the cascading effect was in the last 1 week. So the DGCA is saying that you are not properly managing this entire schedule. So if you're not capable enough of doing all of this, flying all of these flights, then you should have to curtail on some routes. Now, these routes are routes where Indigo is a dominant player, but there are also routes, sources are telling us, where other players are also they have a presence, so that the passengers don't feel any inconvenience. So for routes which are heavily dominated by Indigo but also have players like SpiceJet, Akasa Air and Air India, those are the routes that DGCA has asked them to cut. Now, how many flights are to be cut in the month of December? The calculation comes around to 110 to 115 flights per day, which is a daily schedule. Now, we'll have to wait and watch what DGCA says, asks Indigo to do from now onwards. And they've asked Indigo to come up with a new revised winter schedule by the 10th, which is tomorrow by evening. So Indigo right now is working on that. On the aviation minister's end, he's constantly been saying that he will make an example out of this. He will, the Indigo will be held accountable, and it is being held accountable at this moment. But we have also heard chatter about the fact that other airlines will be given an opportunity to increase capacity in the winter schedule. But that's right now, sources tell us at other airlines that that is going to be difficult for the other airlines to match, because increasing capacity in an already very busy month is going to be difficult. So we'll have to keep a watch on how it functions from here on. Right now, the latest is that 5% cut, 110 to 115 flights daily Indigo will have to cut in the winter season, at least in the month of December.
Very quickly, there was also some newspaper articles that the government may look to redistribute some of Interglobe Aviation flight slots. Have you heard anything on that?
Yeah. So absolutely. Now, the problem here is that I've been speaking to sources at various airlines in the country, and what we have understood is that, there are a fixed number of pilots and aircraft that all of these aviation industry businesses have. So winter is already a very busy month for all of them. So what we understand right now is that be it SpiceJet, be it Akasa, or be it Air India, all of them have increased slight bit of capacity in the last 1 week. What we heard from sources is that SpiceJet, of course, came out and told us on Twitter and on other social media that they have increased flights to certain routes where Indigo was a dominant player. Air India also has increased. Say, for example, yesterday Air India flew 12 extra flights on various domestic routes. So, of course, airlines are doing their bit in increasing capacity, but to give them a blanket 1% or 2% directive to increase that capacity would be difficult for airlines to do, because they also have a winter schedule which is increased from the summer schedule. So, whether or not they have that kind of capacity to be increased, we'll have to wait and watch. So clearly, airlines are not comfortable at this point to say that, okay, we'll increase it by 1% or 2%. So we'll have to wait and watch on that front.
Thank you very much for that comprehensive explanation. But let's also listen in to the Civil Aviation Minister, Ram Mohan Naidu, who spoke at the Lok Sabha about the measures being taken amidst this crisis.
Going forward, the government is determined to build a more robust and competitive aviation ecosystem. Through our policies, we are encouraging more new airlines to start and operate in India, ensuring fair access to airport capacity and eliminating any possibility of duopoly, controlling connectivity and pricing in our skies. More airlines mean more choice, more affordability, and more resilience for the passengers. Operations are stabilizing fast. Safety remains fully in force. Indigo is being held accountable, passengers' convenience and dignity are being protected, and long-term measures are underway to make India's aviation sector stronger and more passenger-centric.
By the way, the forgotten stock SpiceJet has been moving up for the last 3 days. So I think in the last 3 days, it's moved up from levels of 30 to now above 34. So that's an up move of nearly 15%. Dharmesh, you want to comment on Interglobe Aviation, or is it time to look at SpiceJet also?
I mean, it's really perplexing, the type of moves, even the decisions from the government is coming. Before you sanction a flight rule, I mean, very simply, you could have put into place how much crew is there, how many pilots are there. And this rule which was implemented, that was there in force. I mean, they knew this rule. So I don't understand why this was not taken into account before, sanctioning the winter schedule or summer schedule and whatever schedules it is there. And again, they are telling to cut 5% and giving 1 or 2% to others. So procuring the aircraft is another challenge. I mean, from where SpiceJet or, Akasa or Air India will get aircraft to fly these routes, additional routes. So, and again, the pilot will be a challenge. So the basic problem here was the lack of pilots to fly the number of routes with the allotted time schedule which was given to them. So that has to be addressed, and I mean, that's not happening. So that's really a sorry state of affairs. But at the same time, because this hit will be there on Indigo with 110 or 100 flights being cancelled every day, definitely for the stock, this is not good. I mean, there will be a correction happening out there. And some, parity gain can go to SpiceJet and likes. But SpiceJet itself is coming out of too many problems out there. So fundamentally, I think it's time to keep away from this aviation space for some time till this entire thing settles down.
Dharmesh, point taken. Thank you very much for joining us. Good speaking with you. Let's get Nigel in, who's walked across to the F&O setup with the latest. Nigel, what's happening?
Well, you have the Bulls and the Bears that are having an equal fight actually today. Both have had their shares of brilliance throughout the day. And as we speak, the volatility is picking up yet again because we're entering the final 60 minutes of this particular contract. But one positive factor is, in a market that's a little bit wobbly, the VIX is still at very, very subdued levels. That's telling you that, in fact, at least in the near term, that fear index is not spiking up, which is pretty okay. The other positive is that the advanced decline ratio on the Nifty, well, that is the best we have seen since the 26th of November 2025, which means after a long time, the number of stocks that are advancing are more than the number of stocks declining all the way since the 26th of November. That's a few trading sessions ago. The PCR, at the start of today, it had moved to around 0.6, and that's why I said from the lows of the day, we could see a bit of a recovery, because 0.6, 0.65 odd, on the headline index at least, you'll get a bit of a recovery. Why has that happened? Well, the 25,800 put. There is some writing that we've seen out there. In fact, there's a mix of activity out there. But on the call side, there is aggressive writing being seen. 25,850 call. The premium is down just to around 4-5 rupees approximately. At the start of today, it was 140 rupees. So those writers, they're very, very aggressive. To give you a couple of goalposts, the high of the day, 25,924, that seems to be protected because the bear scheme, fighting back. And, on the downside, actually, that is 25,728. Just want to correct that number for you on the screen, 25,728. The stock that we're looking at is Keynes. That's going to be the important one. because the last time I checked, the open interest as a percentage of MWPL has come down from more than 95% to around 79%. It has to end sub 80% to come out of the F&O ban. And I think in all probability, going by the data points that we have, that should be out of the F&O ban. So keep an eye out on that one. Shorts getting squeezed as we speak.
Okay, all right, Nigel, thanks very much for that. So keep an eye on how this moves from here. We take a break. We are back. Varun Goyal of Mirae Asset is going to be with us with what he's doing in markets right now. Stay tuned.
26 years of CNBC-TV18.
Welcome back. The Nifty is once again gravitating towards 25,800. The intraday low today was 25,728. So we're still about 90 points off from the session lows. But the cumulative cut from yesterday and today is in excess of about 350 points. Sorry, actually much more than that, closer to about 400 points now, lost over the two trading sessions on the Nifty. But let's go across to Hormus, who's putting the spotlight on the top movers in the market. Hormus?
Contrary to what has been happening over the last few trading sessions, the broader markets today is showing some signs of green. And Keynes Tech has been the talking point all through last week, through this week as well. Today, the stock is up 11% and the biggest single day gain since November of 24. And today, in this 28-day bearish period that this stock has had, today's volumes are the highest in this 28-day phase that the stock has had. And before today's session, in the last 27 of them, the stock was down in 22 of those. And today has been the second straight day of more than 1 crore shares being traded. We have already seen more than 1.5 crore shares traded on the stock. 20-day average of just around 15 lakh shares. And to show the kind of moves that Keynes has had, before the start of this year, in the previous 25 months, the stock had declined in only 2 of them. And today, Solara is the other one that is moving higher in today's session. The biggest single day gain in the last 6 months is gained in 5 out of the last 7 trading sessions has Solara. Today's volumes are the highest since April of last year. And close to 30 lakh shares have been traded on Solara today, 20-day average of around 1.5 lakh. And it's trading at very important levels. The 50-day move, the 100-day moving average at 611. So it's finding some resistance there. The stock has been an underperformer this year, down around 10%. And 4 out of the last 5 years have resulted in negative returns for the stock. Ixigo is the other one. And the stock snapped a 8-day losing streak yesterday. And so it's now the second straight day of gains for the stock in today's session. Volumes are the highest in over a month. Over 85 lakh shares have been traded. The 20-day average around about 14 lakh shares. The next important level to watch on the upside is the 100-day moving average of around 273. And the stock down around 24% from its 52-week highs, but has done fairly well from its IPO price, which was close to around 100 rupees. And lastly, Tata Tele snapped a 5-day losing streak today. And out of the last 17 trading sessions, the stock had gained only in 5 of those. And the volumes today are the highest in the last 6 months, with close to 11.5 crore shares being traded on the stock. The 20-day average is only 15 lakh shares for Tata Tele. The stock has moved above or just around about its 50 DMA at 54 rupees. The 100 DMA is at 56. And after 6 straight months of losses, the stock has finally turned positive for the month of December after today's move.
All right, Hormus, thanks very much for that. Appreciate it. Well, Varun Goyal of Mirae Asset is now with us to take some questions on stocks which are moving and both sides. And the two big movers lately have been and Varun, I think this is all, most of the price damage on Keynes has happened from the last time we spoke. Actually, it's happened in the intervening period. Indigo is the other one which has lost and is losing as we speak. So just wanted your views on these two situations. I know you're a little reluctant to talk about individual stocks, but if you can give us a pointed answer on both these names in terms of how you're thinking about these situations.
Good afternoon, Prashant. Thank you so much for having me on the show. I think, as far as we are concerned, the attractiveness of the overall EMS space continues. There is a significant government effort in creating a domestic manufacturing scenario for most of these components, be it a mobile, laptop, and several other electronic components. So I think the space will continue to do well. We will see a hyper growth kind of a phase for the next 3, 4, 5 years, backed by significant PLI benefits. And therefore, the attractiveness of the space remains. I think broadly within that construct, one would have to look at accounting quality, one would have to look at valuations and see wherever one is comfortable. But I think broadly the space remains attractive. I think as far as the travel, tourism, hospitality space is concerned, I think that's a secular long-term growth story. I think companies in the travel, aviation space should continue to do well. In the short term, the new rules and regulations by the DGCA will ensure that the profitability comes down at the margin for the sector as a whole. So one will have to realign the profitability metrics for all companies in the sector. And to that extent, there might be some kind of a valuation reset for the space. But beyond that, we believe the growth runway seems to be quite large.
So in the near term, you foresee pressure for, say, the airline industry because profitability takes a hit. So this is not the time to buy, even if you believe in the long-term story.
So, like I said, the medium-term attractiveness of the travel tourism space continues to be very much in place. But yes, in the short term, we believe that the manpower cost for the industry will definitely increase. And because of that, there might be a reset on the profitability of the sector.
All right. Hi, Varun. Good afternoon and good to see you in. How are you feeling, though, about the broader markets? Times like these where you have parts of retail capitulation, the kind of selling that we've seen. I'm just pulling out some data from the NSE. And retail or large individual investors have sold $3 billion, in the last 3 months or so after backing up this market. And that's what's causing the broader market pain. Do you think it's a good time to gradually start getting in? Because we've seen in the past, when that advance decline ratio goes absolutely dismal, when a lot of individual investors start selling out, suddenly some of the stock prices get depressed and provides a good entry opportunity. Your take?
Good afternoon, Nigel. Our belief is that the cyclical recovery in India is only getting stronger. Our sense is that with so much GST cuts, direct tax cuts, and interest rate cuts, it's a matter of time where growth picks up. The commodity outlook remains extremely benign, which is also very good for the profitability of the overall industry. So from our point of view, earnings are definitely set to get better. So while FY26, we expect a 10% kind of earnings growth for Nifty companies, I think next year it should be more like 14-15%. And I think the bigger story is playing out in the small cap space. That's where last 4 or 5 quarters have been negative earnings growth. In fact, I think last 4 quarters, if I'm not wrong, it's up, it's minus 10% plus. More than minus 10%. And I think from here, we are seeing a turnaround in earnings trajectory. I think starting from the January quarter, we expect small cap earnings to get back into green and led by small cap financials. Clearly, that's a space which will lead the earnings growth recovery. So in our view, small cap and mid cap should actually do better in the next calendar year.
All right, encouraging to hear. Small and mid caps do better than the headline index. Good to hear, because last few months actually have been quite painful for portfolios. People are not feeling like the markets are anywhere near all-time highs. That said, let's focus on a couple of other sectors. Tech, I've seen in the past, you had some of these large tech names, Infosys, TCS, they were part of your portfolio. And in the last 2.5 months, tech has been a pleasant surprise. The index has rallied 15%. It's still down more than 10% in the last 1 year, even after this big rally. How are you feeling about the index? Have you increased weightage out there, or are you all still at the sidelines?
I think the large cap IT space continues to be very attractively valued. I think we will start seeing a revival in discretionary spending from next quarter onwards. I think they're trading at 5-year average multiples with good free cash flow yield. So for us, that remains attractive space. I think there's some pockets of mid cap IT which are still expensive, where further time or price correction may happen. We are incrementally more positive on some of these BPO stories on the healthcare side and other sectors where the growth seems to be very strong, and that's where we believe next 2-3 years should be pretty interesting from a compounding point of view.
All right, and from the banking and financial pack, you were very positive, right? You're like, I think you'll had pockets of private, public, as well as NBFCs. What is the order now that you're looking at? Because the rate cuts have come about. For the banks in the near term, it could be a headwind on the NIMs. But otherwise, credit growth is picking up. That's encouraging, not just for the banking names, but for the, for the country on the whole. How are your positions on BFSI?
I think we continue to be pretty constructive on the overall BFSI basket. The valuations seem to be the most reasonable amongst various components of the market. I think credit growth is running at 11%. With further monetary easing, this can go higher, which means that for Tier 1 banks, both public and private, we can easily see 14, 15, 16% kind of credit growth. There is still no sign of a bad credit cycle. So I think the asset quality remains quite good. We had some issues in microfinance last year, and that seems to have bottomed out. And I think various parts, be it SMEs, be it personal loans, seem to be doing okay. So I think we are looking at a fairly good 15 to 20% kind of earnings growth for BFSI names on the large cap side, and some of the mid cap names can actually grow faster. So we continue to be positive on both public and private sector names on the banking side.
Okay, all right, Varun. Good to hear your thoughts. And for me, the big takeaway is that in times like these, where there's a lot of pain in the broader markets, you're actually expecting an outperformance from the broader markets for 2026. Cheers to that. Thanks a lot for joining in. Well, as we had that chat, actually, select stocks in the broader markets have seen a good spike. Some of them have got hit very, very hard. Supreme Petro should come up for you on the screen. Big uptick is what we're seeing on that particular name. Tilaknagar Industries, another stock that saw a slam dunk. That as well has spiked up a little bit. So I think we should get a few of these names up for you on the screen. And you have Indigo Aviation as well. That's another stock in there that's seen a good bump up. Pull up Supreme Petro as well. I think that was one of the other stocks that are coming up on the list in terms of a sharp uptick in the last few minutes. Well, we'll slip into a short break, come back, we'll continue our focus on the markets. We'll give you some technical trading ideas as well.
"26 years.
Welcome back. You're tuned in to Closing Bell. By the way, we have some comments that are coming out from the Indigo CEO on X. He says that they're flying more than 1,800 flights. On-time performance is normalized. So on the back of that, actually, you're seeing a sharp uptake in the stock. They're starting to focus internally on what led to the issue, and they're trying to clear out things. And I think there's an apology as well coming in from the CEO. So on the back of that, you're seeing a bit of a relief rally. Remember, the stock is down 20% from the recent peak. There is a bit of buying that we're seeing on the counter. We'll try to get you the latest on that front. But the big takeaway is the operations are now stable, and so the street likes it. And that's why you're seeing that the stock is flying away. Big recovery from the low point of the day. All of that in the last 30 minutes or so. Well, let's get in Mitesh Thakkar to tell us, what's the call with regard to stocks. Mitesh, a couple of trading ideas, and if you had a call on the Nifty, just to revise it.
On the Nifty, Nigel, I have maintained that 25,800, 780 on a closing basis is the zone. We most likely, trying to stay and above that. So as of now, I think, not looking at shorting ideas. I think the only unfortunate thing which can happen is that you get a gap down tomorrow or day after. But I think for the timing, since the support is not broken, we believe that there is a chance of markets coming back into the range for the near future. On the stock side, HAL is a BTST with a stop at about 42.90 for targets of 43.40 or thereabouts. And one STBT is Hero Motors with a stop at about 6,015 for targets of 5950.
Okay, all right. That message from the Indigo CEO certainly having a bit of an impact. Mitesh, any thoughts on this one, Indigo, technically?
So, Prashant, I think the only positive thing on the chart of Indigo is that it's extremely oversold and therefore can give a bounce back. But I suspect in the near term, 5250, 5300 is the area which the stock might find very difficult to get past, and the correction could still see eventually stock hit levels of around 4700 to about 4675.
I see. Okay, all right. Brief reprieve for now. Mitesh saying maybe may not last at about 5200 kind of levels is where it'll find resistance. Let's get Mitesh, thanks very much for that. Yash is now joining us with an exclusive. Remember, LIC, the country's largest insurer, has been saying that they want to acquire a standalone health insurer. They want to basically get into life health insurance, and all kinds of reports about how due diligence is happening. We understand that that plan is now being shelved. Yash, tell us more.
Well, as you rightly pointed out, there was a fair bit of excitement when it comes to LIC's foray into the health insurance industry. The company had said it. The companies also said it, that they were doing the due diligence for acquisition of the strategic stake in a health insurer. And there was fair bit of fear amongst the incumbents also with a player like LIC entering. But all of that seems to have been abated at this point of time, as we are given to understand from our sources that LIC is likely to have put its plan to acquire a strategic stake in a health insurance company on a back burner. As I said, the intention was there, due diligence had started, but all of that seems to be behind LIC right now, and that plan for now seems to have been shelved. What we are given to understand is that right now the entire focus at LIC from the company's end and the government's end would be on that offer for sale or OFS, where the government would be selling certain part of its stake in the company. It has to comply to bring its stake to about 90% by May 2027, and the process would start with the OFS getting launched, according to our sources, as soon as in the month of January itself. So the entire focus right now on that OFS, and after that the entry into the health insurance space through that strategic acquisition looks like it has been shelved for the moment.
Okay, all right. Thanks a lot, Yash, for joining in and giving us that important story. That said, let's get back to the technicals of the market. Jay Bal of Cash the Kiosk joins us on the show. Hi, Jay. Good afternoon. How are you feeling about the markets? I think you were in the camp that were calling for higher levels. So revise, what's the outlook for the next 1 year or so? And where does support come in for the Nifty?
Hi, Ranjal. Good to be on your show. I pointed out last time the support level of 25,840 was an important level, and the markets are starting to trade below that. So my opinion on the market from a 6 months perspective remains unchanged. I'm anticipating fresh surge to all-time highs. But the immediate term, there is a good possibility there is a bull market interruption that's coming. And possibly the Nifty could revisit 25,000 to 24,400 if the markets were to close below 25,840, which I think is likely looking at the price action today. But this won't be an easy shorting opportunity. So what you can do is lighten up on the profits that you have made since May of this year to November of this year, and wait for adding back those candidates that you have made profits on. And the markets making fresh record highs to 26,325 and not following through is an yellow flag for the market. And there's the probability the markets are likely to dip to something like 25,000 and then surge back to record highs is the most likely outcome.
Okay, all right. So a dip and then a bounce back is what we're likely to see on the index.
I think this is a change, Jay, right? From last time. You've extended downsides because you were hoping that markets will bounce from where we are now.
That's right, Prashant. No, I pointed out that if Nifty were to break 25,840, that's the bull-bear divide. Once the bull-bear divide is taken out, the possibility of a short-term correction is quite pronounced. It's a very good possibility. So and it could be something like further 800 points. And given the base of Nifty where it's 25 odds, 800 points need not be that disruptive.
Okay.
But it can be a little bit of pain in the short term. So, but I think the markets are still in a bullish uptrend. But the fact that markets registered fresh all-time highs past 26,277, that's a signal that the medium-term trend is still up. But in Elliott wave parlance, we call this as a irregular B wave. So we need to see a sharp down back to the August lows or some back close to it, and then the markets are likely to surge to fresh record high.
All right, a visit to 25,000 and then resume the uptake. That's what Jay is saying. Jay, we're going to come back to you. But by the way, in the last few days, there are two stocks actually that have soured sentiment. One is Keynes because of various queries that have been raised with regard to their cash flows as well as their balance sheet. That's locked in upper circuit, 15% up as we speak now. It's in an upper freeze. So, you can't get the stock as of now. And remember, we have been highlighting it's likely to come out of the F&O ban. And the other one is Interglobe. Big recovery is what we've seen. In fact, let's play out a soundbite coming in from the Indigo CEO, that we're just getting.
To addressing your needs as a customer, the restoration of Indigo's network and flights was being done on a war footing. On December 5th, we could only fly 700 flights. Thereafter, gradually yet steadily improving to 1500 on 6th, 1650 on 7th, 1800 yesterday, and today more than 1800. As of yesterday, we are back of flying to all our 138 destinations in our network, and our on-time performance has also been normalized. Earlier, we had indicated to normalize between the 10th and the 15th of December. I can confirm now that today, as of December 9th, our operations are fully stabilized, which means flights reflecting on our website are scheduled to operate with an adjusted network. So please continue to check our website for updates. We continue to work in full cooperation with the government. And now that the immediate crisis is dealt with, we started to focus internally on what has led to this, lessons learned to be drawn, and how to emerge stronger from this.
All right, so that's the Interglobe CEO reassuring investors as well as customers that they're getting back to normalcy, which is good news both from a shareholder perspective as well as from a customer perspective. But since we're focusing on stocks, Jay, give us a couple of trading ideas, individual stocks.
Yeah, one is on tire stock, LG Balakrishna, with a stop loss of 1750 and an objective of 2100. I just want to reiterate, since my anticipation is for the market to drop a bit sharply in the short term, you might want to allocate lower than your usual allocation because we are betting on a possible candidate swimming against the stream. And I have a short call on Bajaj Finance. Bajaj Finance with a stop loss of 1061 looks like it's likely to drop to 940. But once again, this is a very short-term call. The medium term looks positive for Bajaj Finance. So keep it, keep it real and keep it small.
Keep it small. Okay, all right, Jay, take a break. Stay with us. We're coming right back. I think there is 9 minutes to go for market closing. Stay tuned.
"26 years of CNBC-TV18.
Welcome back. There's 5 minutes to go for the market closing. The CG Power stock will come up on your screens. It's up about 3%. It struggled. It struggled actually, since actually it's quite eerie. It struggled since. It's been flat since July of 2024. Guess what happened in July of 2024? Mr. N. Srinivasan, the man who turned CG Power around when it was hit by that scam, he took over in 2020 and ran the company till July of 2024, and then, of course, he stepped away. One of the most brilliant turnarounds. He's written a book. It's called The Great Revival, basically documenting the journey in terms of how he was able to turn that entire company around in such short order. It's one of the most successful turnaround stories. And later today evening, you can catch that entire conversation with the Murugappa Group veteran, Mr. N. Srinivasan. He's, of course, also the former MD of CG Power. One of the finest sort of legal minds, financial, legal, and an outstanding job that he did at CG Power. So that's an interesting conversation coming up a little later at 5:30 today. Okay, we've got markets now, here and now. So let's keep it with that. Jay is with us. Jay, something like the Keynes, how does one approach it? Complete collapse, and now we've got a 14-15% bounce. The risk always is that this is a bit of a dead cat bounce.
Yeah, that's more like it, Prashant. If you look at the medium-term charts, it's coming off from 7895, which was the all-time high it made, and today the intraday low was below the previous low of 2025. So this is possibly a double top signal from the stock. So you might want to be a bit cautious, as you rightly put it. It could very well be a dead cat bounce. So it's never a wise thing to catch a falling knife. Let the momentum and dust settle down up to the downside, and then we can look at it. So if the stock were to close below today's low, it will confirm a double top for the medium term. So the double tops are quite dangerous. So watch out for it. Use the opportunities as an exit opportunity. The bounces as an exit opportunity.
What about Indigo?
Indigo, the August high marked as an important peak for the stock in the medium term, and we're likely to see a little more downsides in the short term. But the medium term picture is still positive. But in the short term, some more downsides to work with. It's a short term avoid, probably a medium term pick once the downsides are completed. I would anticipate something like somewhere close to 4,000 to 3,900 for the stock to be the right point to start looking at it positively from a medium term.
Okay. Lots of other names. Ixigo, Jay, if you've looked at this one.
I haven't looked at it recently, but I do.
High was 334, not that long back. Fell 100 rupees and coming back a little bit, 260 now.
Yeah, the short-term momentum is still to the downside. So, and there is a gap, unfilled gap for the stock. So I would anticipate probably a retest of the gap, what we call as a falling window, and then come back to lower lows. But yeah, the stock's medium-term picture is positive. I would still wait for short-term downsides, very similar to Indigo.
Okay, all right. Stay with us, Jay. Just coming back to you, we just have to wrap up the market as it closes. We're down 130 points, 25,830 is where we finally end. Maybe, just a quick look at indices. PSU Bank Index, the biggest gainer, 1.25% higher. Small caps did well to come back in a very strong way. So the small cap index fell at open and then picked up very, very sharply, never looked back. Then you have the real estate index, which ends about 1% higher. The defense index about 1% or so in the green as well. IT was the big loser. Actually, yesterday in a falling market, IT did well. Today, of course, it went the other way, 1.25% lower on the Nifty IT Services Index. Just a quick look at the Nifty 50 names and what stood out. Asian Paints on the downside, nearly a 5% cut in Asian Paints. HCL Tech, Tech Mahindra, Wipro. These were the three top Nifty gainers, and they're the three top losers today. So no real method to the madness in that sense. On the upside, Eternal was up about 2.25%. Swiggy was up as well, but Swiggy, of course, outside the Nifty. Within the Nifty, Eternal, Titan, Adani Enterprises, and of course, because of the last 30-40 minute flourish, Indigo counts as one of the top gainers on the Nifty, which is about 1.25% gain, but off the lows by about 4% or so. Broader market, a lot of action. Almost twice the number of advances as compared to declines, so there's quite a bit of turn. Keynes ends up as the #1 volume-led gainer with a 14.5% pop. Eris Life Sciences with the 11% gain, big one. Excel Soft, that's a recent listing, 2 months, second month in the market, about 97. Ixigo 8%, we just discussed that with Jay Bala. Then you go down the list, there's a few, Texmaco Rail, Kernex Systems, these are up 7-10%. But then, thins out pretty fast, even though advanced decline numerically, many more up than down. BSE was the top loser on the broader market, 3.5% down in volumes. Coforge was down 4%, Aether was down 4.5%, eClerx was down about 5.5%, and so on and so forth. Actually, enough and more on the downside with volumes as well. It's a wrap on this edition of Closing Bell from all of us here. Goodbye. Thanks very much for watching. Markets Forward with Jay Bala coming up in just a bit.